On the other end, there are sectors like bank, IT, pharma, consumer staple, telecom, auto, cement, where valuations are still reasonable. You are investing for retirement, which is 20 years away. Then you can't afford to be in debt beyond a point because you have to outperform inflation also. We are also telling investors that you have to moderate your return expectation and be ready for volatility because market has a dream run. I don't think so we are going to see what we got in last 5 years over next 5 years. It's more likely to be towards what was before that.
Hi guys, if you've been keeping a close eye on the stock markets, then chances are that you've come across this name quite frequently. Nilesh Shah, he's the MD of Kotak AMC. He's here with us today to share his insights about the stock market. So receiving payments, especially lump sum payments, can be quite daunting as a fund manager. Also especially considering that you have to deploy it given the current market scenario. Plus, sitting on cash is also not a wise option, considering it would drag the overall portfolio returns. So how do you navigate this situation?
So one, as a batsman, can I always expect half volley and a betting pitch? Answer is no. It is the bowler's job to give the toughest ball to us. And as a batsman, no matter what pitch it might be, I have to play the game. Investment is also like this. I wish someone would have given me all the money at 7,500 Nifty. But would that have been possible? So, one, we don't take stress of getting lump sum money or getting SIP. What we focus upon is communicating right message to the investors. So we push SIP saying that this is long-term investment. There will be Agni Pariksha in SIP like March 20 when 3-year SIP returns of my equity funds were negative. 10-year returns had come down by half. This is the time when you have to do SIP top-up. Right now, as we speak, our Kotak AMC fund NFO is open. In our advertisement, we have written, please invest with 5-year horizon. We are also telling investors that you have to moderate your return expectation and be ready for volatility because market has a dream run. So if I have done right selling, then it doesn't matter whether I get lump sum money or I get SIP. As a fund house, we don't take cash call in most of our equity funds other than asset allocation fund. I believe my customers and my distributors are giving me mandate to manage money in a particular asset class. And hence I should invest in that asset class because they have already taken that asset allocation call. It's possible that some investor may expect that, at the high of the market, you should move 100% in cash. At the bottom of market, you should put 100% in equity, even in a fixed income fund. Well, those are all the hindsight benefits. Is it possible to pick up the top and bottom of the market? Answer is no. So our focus is do right selling and then manage money as per the mandate. We are not absolute return provider. We are relative return provider. My job is to outperform benchmark indices. If market goes down 10% and I fall 5%, I'll be very happy. My client may not feel happy because they still would have lost 5%. But if I've sold it correctly, that you have to invest for 5 years, you have to do SIP, then that correction is a great opportunity for them to buy.
So considering all that, how should investors allocate? Like what should be their preference for asset allocation considering equities, commodities and debt?
So people have to be truthful to themselves. When I ask people, are you aggressive? Today most people say yes. Then I ask them, did you buy in March 20 COVID period? If not, then you are not aggressive. If you have sold, then you are very, very conservative. And if you didn't do anything, then you are average risk taker. You are not aggressive risk taker. So first be faithful to yourself and analyze who you are. Otherwise, what will happen? You will buy at the top, sell at the bottom. You will be greedy at the top, fearful at the bottom. That's not the way to make money. Second, have investment objective. You are investing for retirement, which is 20 years away. Then you can't afford to be in debt beyond a point because you have to outperform inflation also. So as long as investors are confident about the risk profile and their investment objective, asset allocation can follow. At this point of time, our view is that in debt, go for longest possible maturity or duration. Gold, we are bullish on gold prices, and hence one should invest slightly overweight position to gold. In equity, we think it is time to be neutral weight, no leverage position, no overweight position. And within equity, focus more on quality over momentum, focus more on large cap over mid cap or small cap, and focus more on reasonable valuations than expensive valuation.
So I think it's also about maybe moderating one's expectation from equities at this point, considering.
Undoubtedly. The 5-year return from Jan 20 to September 24 was about 21%. 15-year before was just about 11%. Now, what kind of return you are going to get over next 5 years? I don't think so. We are going to see what we got in last 5 years over next 5 years. It's more likely to be towards what was before that. So moderating return expectation is the most important thing. Normally fund managers, get scolded when we give negative return. My fear this time is that we will deliver below expectation results and hence people will be unhappy. And which is why it is important for us to moderate their return expectation so that they can remain invested for long term.
So what are the kind of returns that an investor should expect from Indian equities today?
Our market has become fairly matured. Earlier, there was information advantage. I used to get balance sheet as a fund manager way ahead of my cousins in Ahmedabad or Rajkot. I had access to company management well ahead of many other institutional players because we are a big fund house. Today, thanks to all of you, access is universal. You bring company management to people. Data is available publicly. So market has become matured, market has become efficient. And in an efficient market like equity, if you get 2-3% real return over inflation, I think that will be a good return.
So basically maybe mid high single digits?
High single digit to low double digit will be appropriate.
So how do you approach conversations with foreign clients who are concerned about valuations? Do you see other global markets who are maybe as appealing or more appealing as compared to India?
So when we meet global investors, we first try to understand what is their understanding of India. And we typically start, if they come to this office, look on the right hand side of my window, you will see a hall where world's most expensive wedding happen. If you see left hand side of my window, you see world's largest slum, Dharavi. Both coexist in India. Now, if you only focus on the most expensive wedding destination, you will forget about Dharavi. If you only focus on Dharavi, you will never realize that this has happened. Please keep in mind that India is a combination of both. Whatever one says about India, opposite is also true. And if you want to invest in India, be a long-term investor. Learn to understand India's complexities. We are 140 crore people. There are lots of complexities in us. But my favorite story to global investors when I end my presentation is a photograph of a leopard in an automobile factory. And I say Suzuki of Japan came to India in 80. They started making automobiles in India when not many people were looking at it. They have gone through all the ups and downs of India. In 2003, they were selling 400,000 cars and they were listed in India. Over next 2 decades, it's now selling almost 2 million cars. And they are planning to increase this capacity to 4 million cars over next couple of years. Their stock price in US dollar term has delivered more return than Japanese companies like Toyota, Honda, Suzuki itself, Nissan, and so on and so forth. Today, they sell more automobiles in India than what Suzuki sells worldwide. Their market cap is bigger than Suzuki. And please focus on this leopard. In Maruti factory, once in a while, leopard enters. They cordon that area, tranquilize the leopard, send it back to jungle, and start making cars again. If you are a long-term investor in India, you will see our companies doing far better than their global peers. But once in a while, leopard enters, and you should know how to deal with leopard. That's how we sell India to the foreigners.
So, I mean, FIIs have been pouring quite a bit of money in October. So far, they've been the highest in the past 4 years. So, also keeping in mind that the rally in the Chinese stocks and the other global factors, how do you position India? Also, more importantly, how do you see the flows in the new Samvat here? Do you see both FII and DII flows continuing?
So one FPIs today have more than $1 trillion in Indian market. They have pumped in far less money. It's the mark to market which has resulted into this. Now, in the month of October, we have seen some money going out from foreigners, probably to China or other places. But do you know that after 27% rally in CSI 300, they are today trading where China was 17 years back in September 07.
Very interesting.
My market has corrected 3-4%. I am trading where I was in September 24. So for a longer term investors, after 17 years, they are making money in China or breaking even. In India, it's just 1 month.
Yeah.
More importantly, in renminbi term, CSI 300 EPS went up by 10% in last decade. 2014 to 2024, 10%. Renminbi. Nifty 50 in same period is up 166% in terms of EPS. From 400 odd rupees, we are at about 1100 odd rupee. 166% EPS growth in a decade versus 10% in decade. Now, these are not apple to apple comparison because renminbi and rupee, there is a currency difference. But that's not going to make this picture alter by a big margin. Now, if you are a global investor, where will you go? Country which is going to grow at 10% over 10 years? Will you go to a country which is growing EPS by 100% plus in 10 years?
Yeah.
The answer is very clear.
So also we've seen that probably there has been some shift of flow from China to India, or actually the other way around, from India to China. So do you see that this is a sustainable trend?
Undoubtedly, no. You have made $1 trillion over here. Valuations are a little bit on the higher side. That's why some people are doing profit booking. But India and China both will coexist in investors' portfolio. Both are top 3 economies in the world over a longer period of time. And hence, people will stay invested.
So looking back at sectors at home in India, which are the sectors that you're bullish on? Also, are there ones that you feel should be avoided at this juncture?
So one is business, other is market. We are bullish on many businesses, but not necessarily bullish on the market performance of them, because markets may have discounted all the good things. So let me talk from a market point of view. We believe sectors like capital goods, infrastructure, defense, railway, consumer durables, they have become expensive. They are trading well above historical average valuation, and they'll have to deliver much higher performance to justify today's valuation. It's like Rohit Sharma scoring a century in first inning. We expect them to score century in second inning. If he scores, then we expect next match first inning century. At some point of time, law of average catches up with them. On the other end, there are sectors like bank, IT, pharma, consumer staple, telecom, auto, cement, where valuations are still reasonable. Some are below historical average, some are above historical average. But overall, valuations are still reasonable. And hence, I believe it is time to go into reasonable valuation companies across sectors to write the India growth story.
Is there a dearth of ideas in these overvalued sectors, like you said, capital goods, etc.?
See, it's all about your horizon. I was talking to one foreigner And I said on a 1 year basis, India looks expensive. And he asked me, which investor invests with 1 year horizon in India or equity? On a 5 year basis, India is the cheapest emerging market. And we don't recognize this. Like there's this story in Ramayana where Hanumanji was standing at the shore and thinking, how do I cross the sea to go to Lanka? And then Jambuvan had to tell Hanumanji that you have the power, you just have to realize it and make a jump, you will cross the sea, you are Hanumanji. Sometimes we believe that we also have an iota of Hanumanji in
all of us,
our mind.
Yeah.
Where we didn't realize that India has grown its EPS by 166% in 10 years, whereas others are growing at 10%. We have taken our earnings growth for granted. But global investors will recognize this. India might be expensive on a price to earning basis, but not necessarily on price to earnings growth basis. Our earnings growth is in double digit, high single digit. That will bring investors back to the market.
That would also probably justify the current high valuations.
So current high valuation is function of undoubtedly fundamentals. Our profit to GDP ratio is almost 6% of GDP. Then sentiment, everyone is bullish on India. And finally, liquidity. It's Triveni Sangam of liquidity, sentiment and fundamentals, which is why this valuation. Now, can liquidity dry out? Yes, it can happen. Can sentiment turn negative? Yes, it can happen. Will fundamentals change? As long as fundamentals don't change, I think liquidity and sentiment, even if they go adverse, will eventually come back.
You also mentioned that the positives have probably also been factored in so far. What about the potential negative triggers, and have they been taken into account, or also what are the negative triggers that could impact the run?
Market today is not discounting any negative. There's a geopolitical risk in Middle East, Eastern Europe, and Korea, and China, Taiwan. But market is assuming that no, things will be fine. Second, market has assumed that interest rates will come down. Now, most likely that will happen, but God forbid if that doesn't happen, as inflation spikes up, we could be in a trouble. We have a coalition government, but market is assuming that it will complete full term. If something goes wrong there, then certainly markets can correct. So anything which is not discounted by the market and which happens will be negative for market. It could be political stability, it could be geopolitical risk, it could be corporate profitability, anything.
Do you see a major decline in the market going ahead?
For major decline to happen, some major event will have to happen. For example, today morning newspaper reading was Canada thinking of putting sanctions on India. Now we don't know what that format will be. There is $40 to $50 billion investment by Canadians in India. Now, if I know they have to sell in a time limit, no one is going to give them exit at this prices. If you are a desperate seller, people will bring down prices and then only they can exit. So anything which is not discounted by the market, which is not thought by the market, if that happens, then there could be big correction. Otherwise, no.
What about the US elections, though? Do they pose a big threat to the run?
So, see, US elections are being highlighted far more. What is of our interest is the policies which will be followed. Now, many a times, when people are trying to win election, they speak one thing. But when they come into power, they do exactly opposite also. So my feeling is that we have to focus on US policies. Of course, there will be influence on policies by who wins election. But instead of speculating, let's wait and watch out for what those policies are and then take a call.
So you've also seen the investment cycles over the decades. What's the one mantra that you've stuck to in throughout all the cycles and shifts? Any incidents that you could tell us?
Buy quality for long term. This is the only thing which works in every cycle. Many people think that they will be able to ride the cycle. But this is like surfing. Even if you catch the wave, eventually the wave corrects and you will go down. Very few people will be able to ride out the wave appropriately. Why focus on that? Just buy quality, stay for long term. There's this Swiss watch called Patek Philippe, and their advertises you never actually own Patek Philippe. You merely look after it for the next generation. Good quality Indian companies are like Patek Philippe watch. You are custodian for your next generation.
That's a very interesting analogy, actually. What are the key economic reforms that you would want, like the government, to bring in to boost India's growth?
So, if we see from 1991, our economic history actually began. We started liberalizing, we started removing license permit, we controlled or we dismantled central planning and control and so on and so forth. We have done many reforms, and which is why our growth rate has moved higher. But we have a long journey ahead. We have to do land reforms so that land acquisition becomes easier. We have to do labor reforms so hiring and firing of laborers can happen. We have to do judicial reforms so that tarikh pe tarikh nahi pade. We need reforms on farm agriculture side. So there are many tough decisions which we have to take on land reform, labor reform, farm reform, judicial reform. We also have to make people financially literate. Today, there are so many Indians who go and trade in cryptos, who dabbled in NFTs, who buy lottery, who do gaming to earn money. I mean, those are all short ways to lose money. People lose so much money in Ponzi. I'm sure you would have read in Mint, there was this article about Punjab Agrotech Corporation, Nirmal Singh Bhangu, some 50,000 crore over long period of time, 18 years back. I mean, 50,000 crore 18 years back in today's term will be how much? Maybe 5 lakh crore or 3 lakh crore. That's the kind of money people lost in a Ponzi scheme. So we have to educate our people on financial awareness. So there are so many reforms which we'll have to do. Now technology is changing. We'll have to master technology. We missed industrial revolution for 200 years. India's growth became zero. Of course, colonization also contributed. If we miss digital revolution, there will be a cost to be paid. So one mantra is reform or perish.
So, I mean, like how you mentioned about the Ponzi scheme, is there any advice that you would want to give to short-term traders or to the beginners who think that we are the wise fund managers and we can look at our own money?
So, trader, I will say, trading is injurious to your financial health. 99 out of 100 people lose money in trading, one probably makes. The guys who are making money have better data analytics, better connectivity, better algorithm. If you don't possess those skills, then you are just trying your luck against them. And 9 out of 10, you will be on the wrong side. Which is why in trading, always remember, trading is injurious to ordinary speculators, traders' health.
Very interesting. Thank you, sir. It was a very insightful conversation. Thank you for making time for us.
Thank you.
Hope this conversation gave you some insights to take you forward in your investing journey. Thanks for watching and happy Diwali from all of us here at Mint.